3 weeks ago, the FDIC released their quarterly banking data. Buried in the numbers was something concerning. America's banks are sitting on $481 billion in unrealized losses on their securities holdings. $481 billion. That's not a typo. That's from the Office of Financial Research using FDIC data as of December 31st, 2024. Here's why this matters. When Silicon Valley Bank collapsed in March 2023, it wasn't because of bad loans. It was because they had billions in Treasury bonds that had lost value when interest rates rose. When depositors got scared and withdrew money, SVB had to sell those bonds at a loss. The losses destroyed their capital. The bank failed in 48 hours. That was one mid-sized bank with about $17 billion in unrealized losses. Today, the entire banking system has $481 billion in similar unrealized losses. And unlike 2023, interest rates aren't falling anymore. They're sticky. The E-bonds aren't recovering in value like many banks hoped they would. Meanwhile, the U.S. government is now paying over $1 trillion per year just in interest on the national debt. For the first time in history, interest costs exceed defense spending. This isn't speculation. This is from the Congressional Budget Office, the GAO, and the Federal Reserve. By the end of this video, you'll understand exactly what's happening in the Treasury market, why it matters to your money, and what the actual data, not fear-mongering, tells us about the risks ahead. Before we get into the implications, you need to understand what's actually happening. This is simpler than it sounds. When you buy a U.S. Treasury bond, you're lending money to the government. Let's say you buy a 10-year bond for $1,000 that pays 2% interest annually. Then interest rates rise. The Federal Reserve raises rates from near 0 to 5.3%, which they did between March 2022 and July 2023. Now, new 10-year bonds pay 4.5%. Your bond, paying 2%, is suddenly worth less. Why would anyone pay you $1,000 for a bond paying 2% when they can buy a new bond paying 4.5% for the same price? They wouldn't. So if you need to sell, you have to discount the price. Maybe to $800, maybe $750. You take a loss. This is mathematical reality. Bond prices and interest rates move in opposite directions. During COVID, the Federal Reserve printed trillions of dollars. Much of it ended up as deposits in banks. Banks took those deposits and bought Treasury bonds and mortgage-backed securities because they paid more than zero. According to the FDIC, between 2020 and early 2022, banks increased their securities holdings by $2.5 trillion. Most of those were long-term bonds bought when rates were near zero. Then the Fed raised rates aggressively in 2022 to 2023. Those bonds lost enormous value. According to the Office of Financial Research, using FDIC data, December 31st, 2024, $481 billion in aggregate unrealized losses. This represents 8.6% average loss on the fair value of securities. These losses equal 19.9% of aggregate bank equity capital. Let me put that in perspective. If these losses were realized, if banks had to sell these securities, it would wipe out nearly 20% of the banking system's capital buffer. Because banks don't have to sell yet, they can hold bonds to maturity and get full value back. They mark them as held to maturity on their balance sheets. The problem is liquidity. If depositors withdraw money faster than expected, banks need cash. To get cash, they sell securities. When they sell, unrealized losses become realized losses. This is exactly what killed Silicon Valley Bank. March 8, 2023. SVB announces sale of $21 billion in securities at a $1.8 billion loss. March 9, 2023. Depositors attempt to withdraw $42 billion in one day. March 10, 2023. Bank fails. FDIC takes over. Total time from announcement to failure, 48 hours. SVB had about $17 billion in unrealized losses on their held-to-maturity portfolio. When they needed cash, they had to realize those losses. It destroyed their capital. Signature Bank failed 2 days later for similar reasons. First Republic failed in May. The Federal Reserve had to create emergency lending programs to stop the contagion. That was 18 months ago, with interest rates at 5% plus. Today, rates have only come down slightly to 4.25 to 4.50%. The securities haven't recovered much value. The unrealized losses persist. Now let's connect this to the bigger problem, the cost of servicing U.S. government debt. According to the Government Accountability Office, FY 2024, interest payments totaled $1,126.5 billion. That's $1.126 trillion, up $251 billion from fiscal year 2023, an increase of 28.7% in 1 year. The Congressional Budget Office projects FY 2025, $970 billion to $1.22 trillion. Sources vary slightly. FY 2026, over $1 trillion. FY 2035, $1.8 trillion annually. Let me give you context for how massive this is. The entire U.S. defense budget, $850 billion Medicare spending, net of offsets, approximately $850 billion. Veterans benefits, $300 billion. Education spending, $305 billion. We're spending more on interest than on defense, for the first time in modern history. And that interest doesn't buy anything. No schools, no roads, no military, no health care. It's just the cost of borrowing money in the past. Why did this happen? 2 factors. 1, the debt grew massively. National debt levels. 2019, $22.7 trillion. 2024, $35.5 trillion. October 2025, $38 trillion. The debt increased $15.3 trillion in 6 years. Much of this was COVID relief spending. Some was tax cuts, some was regular deficit spending that never stopped. 2. Interest rates rose. When rates were near zero, 2020 to 2021, interest costs were manageable even with high debt. But when the Fed raised rates to fight inflation, average interest rate on federal debt rose from approximately 1.5% to approximately 3% plus. On $36+ trillion, even small rate increases mean hundreds of billions more in annual costs. The mathematical trap. Here's where it gets ugly. This is straight from the CBO. The U.S. government doesn't have a $1 trillion surplus to pay interest. So how do they pay it? They borrow more money. They issue new Treasury bonds to pay the interest on old Treasury bonds. This increases the total debt, which means next year the interest is even higher, which requires more borrowing, which increases the debt further. It's a debt spiral. Next decade total interest, $13.8 trillion. That's $13.8 trillion over 10 years just for interest. To put that in perspective, nearly twice what we spent on interest 2005 to 2024 combined. More than 4 times Social Security's cumulative deficits over the next decade. More than 20 times the entire drinking water infrastructure need for 20 years. Interest as percent of revenue. FY 2025. 18.4% of federal revenues go to interest. FY 2035. Projected. 22.2% of federal revenues. Nearly $1 in $4 collected in taxes will go to pay interest, not Social Security. Not Medicare. Not defense. Interest. Interest as percent of spending. By 2031, 15.6% of all federal spending. This will exceed the previous record of 15.4% set in 1996. Interest as percent of GDP, 2026. 3.2% of GDP exceeds previous high of 3.2% in 1991. 2035, 4.1% of GDP. The economy has to grow faster than debt just to keep the ratio from exploding. In 1979, when Paul Volcker became Fed chair, the national debt was $845 billion. Volcker raised interest rates to 20% to break inflation. At 20% interest, the annual cost would have been approximately $170 billion. The government could afford that. Today, national debt is $38 trillion. If rates went to 20%, annual interest would be $7.6 trillion. That's more than all federal tax revenue combined. It's mathematically impossible. The Volcker option, raising rates to whatever it takes to stop inflation, doesn't exist anymore. The debt is too large. Rates are trapped below what would normally be required to fight persistent inflation. This is the definition of fiscal dominance. Monetary policy becomes constrained by fiscal reality. Now let's talk about what the Federal Reserve is actually doing and why they're trapped. During COVID, the Fed bought massive amounts of Treasury bonds and mortgage-backed securities to support the economy. Their balance sheet verified numbers from FedH 4.1 release. Pre-COVID, 2020. $4.2 trillion. Peak, 2022. $8.9 trillion. Increased, $4.7 trillion. They printed $4.7 trillion and bought bonds. Then, starting June 2022, they began quantitative tightening, letting bonds roll off without replacement. Current Fed balance sheet, January 2026. Approximately $6.6 trillion. Reduced approximately $2.3 trillion since peak. That's $2.3 trillion in bonds the private market had to absorb. When the Fed was buying, they provided constant demand for treasuries. Yields stayed low. When they stopped buying and started reducing, someone else had to buy those bonds. Who's buying? Not foreign governments. They're reducing holdings. Not banks. They already have huge unrealized losses. Not retail investors. Yields aren't attractive enough. The remaining buyers demand higher yields to compensate for risk. Higher yields equals higher interest costs. For government equals larger deficits, equals more bonds to sell. Feedback loop. According to the Federal Reserve's balance sheet report from November 2025, on October 29, 2025, the FOMC announced they would end quantitative tightening. Why? Official reason: reserve balances had moved close to ample levels. Translation: banks were getting uncomfortable with shrinking reserves. Money markets were showing stress. Real reason: they can't keep withdrawing support without risking financial instability. The trap: the Fed has three bad options. Option 1: keep tightening. Risk bank failures if reserves get too low. Risk Treasury market dysfunction. Risk recession from tight money. Option 2: stop tightening, current choice. Balance sheet stays elevated at $6.6 trillion. Can't normalize monetary policy. Fed remains primary buyer/holder of government debt. Option 3: resume QE, buying bonds. Directly monetizing government debt. Inflation risk, loss of credibility. They chose option 2. But option 2 is temporary. Eventually, they'll be forced to choose between 1 and 3. The Federal Reserve has effectively become a permanent buyer of Treasury debt. They can't fully unwind their balance sheet without causing financial instability. They can't let the government pay market interest rates on all debt without breaking the budget. They're trapped by the size of the debt. This is fiscal dominance. The central bank can't conduct independent monetary policy because fiscal reality constrains them. Japan entered this exact trap in the 1990s. Debt to GDP ratio started at 60%, now 264%. Bank of Japan balance sheet, now approximately 130% of GDP. Interest rates stuck near zero for 30 years. Result: lost decades, no escape. The US is following the same path. Current US debt to GDP, 100% plus and rising Fed balance sheet, 22% of GDP, down from 37% at peak, but still elevated. Interest rates can't raise high enough to fully control inflation without fiscal crisis. Let me walk through potential scenarios. Not predictions. Scenarios based on historical patterns. This is what we're experiencing now. Interest rates stay elevated, 4 to 5% range. Banks sit on unrealized losses indefinitely. Government deficit spending continues at $2 trillion per year. Interest costs grow as percent of budget. Growth slows under debt burden. Living standards stagnate. This can persist for years. Japan's version lasted 3 decades. It's not a crash. It's a slow decline in fiscal capacity and economic dynamism. Something triggers deposit withdrawals at vulnerable banks. Triggers could include commercial real estate loan defaults. There's $7.6 trillion in CRE loans outstanding. Regional bank stress, geopolitical shock, unexpected recession. Banks need liquidity. They sell securities at a loss. Losses destroy capital. If the bank is large enough, over $100 billion in assets, we get contagion concerns. Depositor panic at other banks. Fed emergency lending. Potential government intervention. This happened in March 2023. The Fed created the Bank Term Funding Program to stop it. Next time, the scale could be larger if multiple regional banks face stress simultaneously. Something breaks confidence in U.S. Treasuries. Possible catalysts: fiscal crisis/government shutdown. Debt ceiling breach. Major foreign holder, Japan/China, dumps holdings. Inflation resurge forcing Fed to raise rates sharply. Yields spike. Maybe 10-year goes from 4.5% to 6% or 7%. Consequences: existing bond values crash. Banks forced to realize massive losses. Mortgage rates surge, tied to 10-year Treasury. Housing market freezes. Government borrowing costs explode. Deficit gets worse, requiring more borrowing at higher rates. Feedback loop accelerates. The government faces a choice. Default, unthinkable but technically possible. Print money to buy bonds, hyperinflation risk. Emergency austerity, politically impossible in crisis. Historical precedent: 1970s stagflation, but with 10 times more debt relative to GDP. The Fed misreads inflation and cuts rates too much. Inflation resurges. They're then forced to raise rates sharply to regain credibility. Higher rates leads to bond losses, leads to bank stress, leads to financial crisis. Or alternatively, the Fed keeps rates too high for too long. Recession hits, tax revenues collapse, deficit explodes. Debt spiral accelerates. They're threading a needle with very little room for error. Debt crises don't announce themselves with sirens. They build slowly, then accelerate suddenly. Examples: 2008. Subprime looked contained until it wasn't. 2010. Greek debt looked manageable until markets stopped believing. 2023. SVB looked stable until Thursday, failed by Friday. The pattern is always, everything's fine. to small crack appears to confidence evaporates to cascade. Let's bring this to your actual financial situation. What do these risks mean for your money? Impact 1. Your savings rate. If you have money in a high-yield savings account right now, approximately 4.5 to 5% annual return. What happens in different scenarios? Slow grind. Rates stay here or decline slowly to 3 to 4% over years. Crisis. Rates either spike if inflation or crater if recession. Your real return after inflation is what matters. At 5% savings rate with 3% inflation equals 2% real return, okay. At 5% savings rate with 6% inflation equals -1% real return, losing purchasing power. At 2% savings rate with 2% inflation equals 0% real return, stagnation. Impact 2. Your mortgage. Mortgage rates track 10-year Treasury yields plus a spread. Current 30-year mortgage, approximately 6.8%. Scenario impacts. Yields stay stable. Rates stay in 6 to 7% range. Yields spike to 6% plus. Mortgages could hit 8 to 9% plus. Yields fall, recession. Mortgages might drop to 5 to 6%. At $300,000 mortgage, 6.8% rate, $1,960 per month. 8% rate, $2,201 per month, plus $241 per month. 5% rate, $1,610 per month, minus $350 per month. If you're buying a home, rate trajectory matters enormously. Impact 3. Your retirement accounts. Most 401s and IRAs hold bond funds for safety. In 2022, when rates rose from 0 to 5%, Bloomberg Aggregate Bond Index fell 13%. Long-duration bond funds fell 20 to 30%. Your safe money lost value. If rates rise further from current levels, 10-year yield 4.5% to 6%. Bonds could lose another 10 to 15%. 10-year yield 4.5% to 7%. Bonds could lose 20 to 25%. This is math, not opinion. Bond prices fall when yields rise. Protection, shorten duration, move to short-term bonds or money markets. Accept lower yield but less volatility. Understand that safe doesn't mean can't lose value. Impact 4. Your job security. If we get a banking crisis or recession. Unemployment impact, 2008 reference. Pre-crisis, November 2007, 4.7%. Crisis peak, Oct 2009, 10%. Duration, took years to recover. Sectors most vulnerable to bank stress. Commercial real estate. Construction, property management. Finance, banks reducing staff. Retail, credit dependent. Manufacturing, equipment financing. Sectors most resilient, healthcare, demographic demand. Essential services, government, utilities. If government chooses to print money rather than default, inflation impacts. Your salary stays the same. Prices rise. You get effectively poorer. Historical example. 1970s. Inflation peaked at 14.8%, 1980. Took decade to bring under control. Required 20% interest rates. Massive unemployment. Today's difference. Debt is 10 times larger relative to GDP. Can't raise rates to 20% without defaulting on debt. Trapped at lower rates than inflation might require. Result? Potential for persistent inflation that can't be fully controlled through traditional monetary policy. Key insight. This doesn't mean panic. It means awareness. What not to do. Panic, sell everything. Make dramatic moves based on fear. Assume crisis is imminent. Ignore reality completely. What to do? Understand risks exist. Diversify appropriately. Maintain liquidity. 6 to 12 months expenses. Reduce unnecessary debt. Don't reach for yield in risky assets. Have a plan for different scenarios. The goal isn't to predict the future. The goal is to be positioned so that no single outcome destroys you. Let me give you the macro perspective. Because this isn't just about bonds or banks. It's about the transition from one economic era to another. From 1980 to 2020, we lived in a specific economic environment. Declining interest rates, from 15% to 0%. Rising asset prices, stocks, bonds, real estate, all went up. Increasing financialization, debt-funded growth, globalization, low inflation, mostly. Every investment strategy, every financial plan, every retirement calculation was based on that regime. We're transitioning to higher structural interest rates, 4 to 5% becoming normal, not 0%. Volatile asset prices, definancialization pressure, debt sustainability questions, deglobalization/friendshoring, persistent inflation risk. Different environment equals different outcomes. Aging populations, US, Europe, Japan, China. More retirees drawing down savings. Fewer workers producing, higher healthcare/social security costs. Less savings flowing into financial markets. Post-COVID supply chain rethinking. Friendshoring instead of cheapest production. More expensive production. Less deflationary pressure from globalization. More inflation bias. Massive infrastructure investment needed. $100+ trillion over decades. Capital intensive, potentially inflationary. Competing with other needs for limited capital. US-China economic decoupling. Separate technology stacks. Duplicate supply chains. Less efficiency. More government spending on defense/security. Higher deficits. This is the critical one. With debt at 100% plus of GDP, can't use deficit spending freely for stimulus, can't raise rates freely to fight inflation, can't grow way out easily, growth slowed by debt burden. Policy is constrained, options are limited. Despite these challenges, the US has advantages other countries lack. Dollar is global reserve currency, deepest capital markets, rule of law, innovation, ecosystem, energy, independence, demographic advantages versus Europe/Japan/China. This buys time. But time is not infinite. It's not, will there be a crisis? Crisis is normal. We've had regular financial crises. 1987, 1998, 2000, 2008, 2020, 2023. The real question is, can the system absorb the next crisis? In previous crises, debt was lower. Rates could be cut to zero. Fed could print trillions. Deficit could balloon temporarily. Next crisis. Debt already at limits. Rates can't go much lower without resurfacing inflation. Fed balance sheet already elevated. Deficit already massive. Less room to respond. Banks are the transmission mechanism. When banks are healthy with strong capital, they lend freely. Economy functions. Crises are containable. When banks have $481 billion in unrealized losses, they're cautious. Credit tightens. Vulnerabilities build. Small shocks can cascade. The unrealized losses aren't the crisis. They're the vulnerability that makes crisis more likely to cascade when something else breaks. Economic transitions are messy. Shift from agricultural to industrial, 1800s. Decades of volatility. Shift from industrial to service/information, 1970s. Stagflation, multiple recessions, massive social change. We're in another transition now, from credit-fueled growth to something else. What that something else looks like depends on policy choices made in the next 5 to 10 years. The data we covered today, the unrealized losses, the interest payments, the debt burden, these are the constraints within which those choices must be made. The facts: $481 billion in unrealized bank losses. FDIC OFR, December 2024. 8.6% of securities holdings. 19.9% of bank equity capital. Elevated for 2+ years. $1+ trillion in annual interest payments. GAO-CBO, FY 2025. First time exceeding defense spending. Projected to reach $1.8 trillion by 2035. 18.4% of federal revenues, $38 trillion national debt. Treasury, October 2025. 100% plus of GDP. Grew $15 trillion in 6 years. Constrains policy options. Fed balance sheet still elevated. Federal Reserve, January 2026. $6.6 trillion, down from $8.9 trillion peak. October 2025. Cannot fully normalize without risk. Recent bank failures. FDIC 2023. Silicon Valley Bank 48 hours. Signature Bank 2 days later. First Republic 2 months later. All had large unrealized securities losses. What this means: these aren't predictions of doom. These are statements of fact about current conditions. The system is under stress. Manageable stress for now, but stress nonetheless. The question is resilience. Can the banking system absorb deposit outflows without selling securities at losses? Can the government service debt if rates stay elevated? Can the Fed manage both inflation and financial stability? All three simultaneously? History suggests these situations resolve in one of 3 ways. Path 1. The muddle through. Slow growth. Persistent, moderate inflation. Gradual fiscal adjustment. Stagnation, but not crisis. This can last decades. See Japan. Path 2. The reset. Crisis forces necessary changes. Debt restructuring, default in some form. Major policy reforms, painful short-term, potentially better long-term. Historically, this is common. Argentina, Greece, etc. Path 3. The inflation solution. Print money to service debt. Inflate away debt burden. Currency devaluation. Savings destroyed. Also historically common. Weimar, Zimbabwe, Venezuela, Turkey. We don't know which path we're on. The data doesn't tell us that. What the data does tell us is that we're approaching a fork in the road. The $481 billion in unrealized losses is a warning light on the dashboard. Not a fire, a warning light. Do you ignore it? Or do you pull over and check what's wrong? For your planning, don't panic, don't ignore, do understand. The verified facts. Interest costs are at record highs. Bank securities portfolios are underwater. Policy space is limited. Risks exist. None of these guarantee crisis. All of them increase fragility. Position yourself accordingly. Diversify. Maintain liquidity. Reduce unnecessary leverage. Understand what you own and why. And most importantly, make decisions based on data, not fear. The data we covered today is all public. It's all verifiable. It's all sourced in the description. Draw your own conclusions. Make your own plans. But do it from a position of information, not ignorance. Thanks for watching.